Welcome to the Jay Tyner Show, where we discuss all things wealth management and retirement planning. And as always, the goal of our team here at Semmax Financial Group is to help you focus more on your life and less on your money. Now, as a reminder, check with your current advisor, planner, CPA, and read our disclosure in the video description below. Subscribe to this channel if you want to stay up to date on all of our new content. And by the way, if you have questions or need a 15-minute free consultation, please visit semmax.com or call 336-856-0080.
Hello and welcome. I'm Matt Landon. I'm joined by Jordan Shinsky. We're both advisors and CFPs here at Semmax Financial Group, and we're going to talk to you a little bit today about Roth accounts. Now, oftentimes people talk about a Roth IRA or a Roth 401k. Let's talk just briefly about what a Roth account is, how it works, run it through. Start me off.
Right. So fundamentally, when we're saving for retirement, traditionally speaking, there has always been this advantage of contributing what you put into your retirement plan, whether it's a 401k or an IRA, as pre-tax money.
Correct.
That means that you don't pay a dime of taxes on it when it's contributed. It then grows tax deferred. But when you take that money out for retirement purposes, everything that you distribute, you end up paying standard income tax rates on it.
Now, historically, the argument has always been you're going to be in a lower tax rate in retirement. Therefore, defer the taxes now. Take it out when you're in a lower tax bracket. The interesting fact is we're in kind of a unique situation right now, and I think we might be in a case where we're about as low as taxes are going to go. If you look at the public consensus, and this is whether you talk to financial advisors, whether you talk to folks on the street, you get a general sense from folks, and it's always what? Taxes are going up or down?
They're going up.
There you go. So with that in mind, it may not make sense for everyone, but you probably are better off going ahead and paying some taxes now and avoiding that increase down the road. So with that in mind, Roth accounts, both Roth conversions as well as contributions, are becoming much more attractive. Now, why don't you walk me through what the difference between a Roth 401k is and what a Roth IRA is?
Okay, so a Roth IRA is exactly what that sounds like. It's an individual retirement account that you're putting money into.
Okay.
A Roth 401k is that which is sponsored by your employer.
All right.
All right.
Now, you're allowed to put more money into a 401k than an IRA, correct?
That's correct.
That's
correct. That is the primary advantage of contributing money to a 401k program. Recently, though, we began seeing more widespread implementation of Roth in 401k programs.
Correct.
Roth in and of itself has been around for about 20 years now. However, it's really only been maybe the last 5 to 7 years that we began seeing 401k programs implementing a Roth component that we can contribute to post-tax.
Now, you might be in a situation where you say, guys, I don't have a Roth option inside of my 401k. You may. Look closely. Sometimes they use different language. So in some cases, they call it a pre-tax contribution and a post-tax contribution. Those post-tax dollars are going to be your Roth 401k. You just may not see it as such because the language isn't what you're expecting. That's one of the things about 401k plans is they're so unique, they're so diverse, there's a lot of nuances to them with each plan, but then along with that, you've got those restrictions. The advantage to the IRA, because it's that individual account, you can do with it what you will from an investment standpoint.
Right.
Now, there's this thing called a 5-year seasoning rule. Now, I'm not arguing that you should spend 5 years seasoning that beef before you throw it on the smoker. I'm not saying anything like that. This has to do with your money. We want to let it season for 5 years. The 5-year seasoning rule can give people a little bit of a hang-up, but it's not that complicated as long as you follow the right rules. One of the big ones is around when you do a conversion versus a contributioning, open the accounts. So when you open an account and you put that first dollar in, you've begun that 5-year seasoning process. So those contributions are going in, they're beginning that 5-year seasoning process. When you do a conversion into a Roth account from an IRA, that bucket of money that gets applied to that Roth account has its own new 5-year seasoning rule. So you may have a fully seasoned Roth account with money inside of there that still has to grow. What's the disadvantage when you pull money out before it's seasoned? So, I mean, maybe it just doesn't taste quite as good, but what does this seasoning mean?
Well, part of it depends on the age that you are when you pull that money out. But if you pull out money, let's say you're of retirement age past 59 and a half.
Correct.
When you pull that money out and it hasn't seasoned, you're going to pay taxes on that growth of that money.
Did you catch that? A Roth IRA is supposed to be growing tax-free, and the whole thing comes out tax-free. You paid taxes on the money you initially put in, but all that growth is tax-free, only if you've given it that time to season. Now, what's interesting is with a 401k, why don't you walk me through a 401k contribution? So let's say I put $18,000 into a Roth 401k the last year before I retire. I've had it open for 5 years. I've been funding it for the past few years, but I just made a large deposit, and then I retire. 2 months later, I roll the whole thing to a Roth. Is it seasoned? Is it not?
So if it's rolled from a 401k into an existing Roth IRA, that is seasoned. Not as, if it's a conversion, it's not. But if it's Roth money in a 401k, it is seasoned. If you take that 401k money, let's say you change jobs and you move it to a new 401k, okay, if we're going from employer plan to employer plan, that's where it starts a new seasoning clock over again.
So that's one of the reasons why when you change jobs, oftentimes you have a choice. Do I want to roll it into my new work plan? Because in many cases they have a work plan. Or do I want to roll it into a Roth or a traditional IRA? That seasoning rule and losing that seasoning is one of the reasons why we generally recommend going ahead and doing that rollover into a Roth or an IRA. I say generally because, like we were talking about earlier at lunch, there's no absolutes. There's no always do this. It's just kind of a general best practice. Now, this has been a little bit of a different take on Roth accounts than we've probably heard in the past. I mean, we understand they're good for us from a tax standpoint, but this is a little more nuance on it. I hope this has been beneficial. It's a little different than what we normally do, but I enjoyed this. I hope you did as well.
Yep.
Do you have any final thoughts you'd like to share when it comes to Roth accounts?
Take advantage of them. The thing about Roth is that, and there's a timing to it, right? Most people, they look at Roth and they think, okay, as you had mentioned earlier, I'm going to take advantage of pre-tax contributions now while I'm making higher money because I want to write off what I'm putting in. The problem with it is that down the road, you're going to be paying the income taxes, and over a 20, 30-year period of time, you may very well have significant growth in that account that you're going to be paying a lot more taxes on. Talk to your financial advisor, develop a strategy for either doing partial contribution into post-tax Roth, maybe some write-off in pre-tax, or maybe do pre-tax within your 401k and contribute to a Roth IRA. You can contribute to one and the other in that particular case. Now, that's a whole other conversation. IRA pre-tax money and IRA 401k money, there are stipulations where maybe it's not deductible. But if you do one and the other, you're okay there.
Right.
So talk to your financial advisor about developing a plan. We're looking at today's tax consequences and how you want to approach your tax profile, but also talk about what the future looks like. What does 20 years, 30 years down the road look like? Because the growth in that money may be significant and may, while it looks insignificant now as a tax consequence, may be much higher years down the road.
Absolutely. I would also say from a risk standpoint, you want to be considering the risk profile of your different money types. They may not all be the same. That's another thing you want to talk to your advisor about. And if you took nothing else away from the seasoning rule conversation we were talking about, the earlier you start, the better it's going to be. So if you're looking at it and saying, well, I'm already retired or I'm about to retire, and that's kind of irrelevant for myself, it may not be for your kids or your grandkids. It's never too early to get them in and to take advantage.
That's right.
And if there's one thing we know, the laws are going to change. The only thing that's consistent in Washington is, well, the bureaucracy and the change. So with that in mind, while you have the opportunity, I encourage you to do the research, check with a financial professional, check with your CPA, with your tax preparer, and make sure you're doing what's right for you, but try not to let an opportunity go by. On behalf of Jordan, myself, and the whole Semmax team, thanks for watching. We hope you have a wonderful day.